Hey, good afternoon, everyone. This is Jack Mannon. I'm the Director of Brand Marketing and Communications for Builders FirstSource. Thank you, everyone, for attending our Market Intelligence webinar today. Just a bit of housekeeping before I turn things over to officially begin. We are going to have a designated Q&A portion at the end of the presentation. Should you have any questions that you want asked to the speakers, feel free to chat them in during that designated time, or you can chat them in at any point throughout the presentations, and I'll make sure they're read aloud to the best of my ability given time at the end of the session. You can do that using the chat feature on the right side of your screen. Without further ado, I'd like to introduce Mike Farmer, President of Commercial Operations for Builders FirstSource. Mike?
Jack, thank you very much, and welcome to our August Market Intelligence webinar. This is our investment to help provide relevant and real-time information on what's going on in the market here on a monthly basis. And I'd like to thank our builder, remodeling, and manufacturer partners for joining us today. We have a great lineup, and we'd like to provide some detailed information and answer any questions that come through the presentation. First up, we're going to have Cyndie Roch, who's our Paradigm VP of Digital Solutions and Architectural Design, followed by Matt Lufkin, who is our Director of Structural Panels, then Jeff Rettig, who's our Vice President of Supply Chain, and Brett Dewey, our VP of Millwork and Specialty Products, and finally, Allie Wolf, Zonda's Chief Economist. So up next, I'd like to turn it over to Cyndie Roch, but first, I'd like to introduce a quick video on BFS's approach to digital transformation.
What if building industry suppliers did more than simply deliver parts? What if they provided expert, technology-driven coordination? Customer-driven, builder-designed, saw-ready coordination that delivers homes, with preventable problems solved before building begins, accurately, efficiently, and virtually. That would be a partnership that transforms the industry.
Thank you, Mike. Guys, I'm so excited to be able to show just a couple slides to you today on what we're doing with BFS's partnership with Paradigm. We are very excited to be able to show you some of the projects that we have currently going. Jack? This slide represents just a few of the documents that are needed in order to construct a home. There are so many people, designs that are incorporated into the field without consideration or collaboration for each other. We believe that digital transformation begins when communication and collaboration are prioritized. The left side of this screen indicates some documents that we consider to be drivers of a coordinated, unified model. And by taking those documents, putting them together in a 3D world and wrapping that 3D model with a BIM coordination effort, we're able then to produce documentation that's very considerate and collaborative with each other. This process may seem complicated, so let me simplify this in just one quick visual. We take a 2D documentation set that you work with today. We create very quickly a 3D model, incorporate any number of the MEP systems that you would want to have incorporated into that model, and then produce clash detection reporting and be able to resolve those clash detections prior to building that house. So what you end up with are marketing materials all the way through trust designs that are coordinated to prevent actual construction problems. This next quick video will show you how it all comes together. Paradigm Technology partnered with our designers out in the field that are supporting you today, are able to pull all of these materials together to not only create a coordinated construction process, but also produce the additional materials that you need to sell and be effective in your market today. Thank you for your time, and Matt, I will turn it over to you.
Perfect, thanks Cyndie. Good afternoon, everyone. I'm going to take a few minutes in supply chain and talk about the current state of the market, the general headwinds still providing some challenges, and both the current and future footprint of manufacturing capabilities in the industry. First bullet point in regards to labor. Labor and a continued low employment rate has continued to provide a lot of challenges for the industry. Everything from workers at the plant, truck drivers, laborers in the field, all continue to provide, quite frankly, a roadblock in driving down the deliverable cost of goods and decreasing building cycle times. A couple other factors, second bullet, when we talk about transportation. Transportation issues remain a challenge for all the industries, but specifically for the forest products industry. The services supplies used to get for forest products is not the same. Mills are not getting the amount of rail cars they need to keep up with the production at full capacity. Demand were to shoot up again, logistics wouldn't be able to really keep up with it as a whole, especially when we're heading into the winter months. When you get into the manufacturing side of things, from a manufacturing perspective, most mills are finally starting to take delayed maintenance that they've been needing to take for quite a while. With elevated prices over the past several years, the mills in general were ran extremely hard. We have started to see and will continue to see both scheduled and unscheduled downtime over the next several months. I'll get to that on the next slide we go to. Looking at the chart on the right, you can still see the demand that's in the marketplace. On a positive note, the multifamily segment is still showing a lot of signs of strength. This will ultimately create a change in the product mix that we need for the job, so we'll continue to keep an eye on what we need to do with our inventory. If we move to the next slide, you'll see a chart where we shared on the last webinar. Most of the data and factors remain the same, with more production needed to support housing demand if we were to stay at 1.4 million units. When we speak to the commodities in general, there's some puts and takes in regards to production moving forward. If you look at panels, we do have a mill conversion of OSB to siding coming out in Q4. Short term, this could have an impact primarily in the North Central, but there is more capacity coming online in 2023. If these new greenfield projects come online once completed, the actual production in the market will be more than there is now. On the previous slide, I mentioned scheduled and unscheduled downtime. This is basically what we call market downtime, which is typically due to the mills hitting the cash cost point of indifference, where shutting down is the same as running the material. We foresee this potentially happening throughout the remainder of the year, and it can be challenging to provide this with longer order files once they decide to do this downtime. One other factor, more on the lumber side, is log supply. This is more relevant in Western Canada as production has to be reduced due to timber supply. Log pricing, availability, and the overall cost have caused some mills to curtail production. In a most recent announcement, 150 million board feet permanently. Although we've seen this primarily in Western Canada, it is causing mills to rationalize production and move it elsewhere, either at an underutilized facility or more capacity in a new greenfield plant in the pine segment. Pretty much concludes the commodity portion, and with that, I will pass it over to Jeff.
Well, thanks, Matt. As you said, we have some headwinds and we have some optimistic and some good news. Next slide, please. So some capacity has come on. So in the decking industry, Trex and TimberTech have both brought on additional manufacturing over the last year. So manufactured decking is quite a bit more readily available. Hardy and LP have both brought on additional manufacturing as well. LP, as Matt mentioned, is converting one of their OSB mills over to produce SmartSide, and that should help start with the more readily available product in Q4 and Q1 of 23. But unfortunately, as was mentioned, we still have some issues out there, and the chemical industry is still reeling pretty hard from a year and a half ago. And that's unfortunately affecting subfloor adhesive, roofing, gypsum, fiberglass shaft liner, and insulation, as well as the EWP industry, especially LVL, is still going to be challenged probably through the end of the year. We'll continue to give you updates as more products become readily available. Brett, I'll turn it over to Millwork.
For Millwork category, we all know that the last 24 months has been a huge challenge, particularly for vinyl windows, as well as moldings and jambs, MDF, and fiberglass doors. The good news is there is significant capacity of vinyl windows being made across the United States. The vinyl window challenge has been solved for this year. We're seeing lead times that had expanded past 30 weeks. Now we're seeing down between 6 to 12 weeks, and we fully expect that trend to continue. The only risk on the windows, there's still some pressure on glass supply, but for the time being, the market is stable in that regard, but the capacity has been added. Moldings and jambs, we all know that has been very difficult. That has improved in large measure because of reduced lead times. We went from a lead time for 6 months for containers of product coming from around the world, and now we've seen a lead time of 3.5 months. So there's a log jam of inventory at distribution at our locations of that products. The good news is the market's strong and it's moving through the inventory quickly, but for the most part, moldings and jambs are in a very good situation. However, for the challenges we expect to see, MDF is still tight. There is new capacity coming on stream. It'll be probably a 2-year time frame before that is added once somebody even announces it. So we expect MDF to continue to be a challenge. It's currently good lead times and be able to service, but that's because the inventory levels are still high. Fiberglass doors have gotten significantly better. Lead times are down, but they are still on the most part on allocation. My recommendation regarding fiberglass doors is stay away from the textured product, stick with the commodity products. They are more readily available, and try to avoid specifying a specific brand. Trust us to be able to fill that opening with what we can find available so that you can close up your homes. That's it on the millwork category. We'll turn it over to Allie Wolf, the Zonda's Chief Economist.
Awesome. Thank you, Brett, and hello, everyone. I am grateful for the partnership with BFS where we can come and continue to give the presentations of what we're seeing on the ground in the housing market. So I'm here, I'm going to set my timer. I have about 35 minutes to get through the state of the housing market and wider economy. As mentioned, I am Allie Wolf, the Chief Economist with Zonda. If you're not familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Now, our proprietary data at Zonda comes from the new home space, but of course, to make sense of the market, you also have to look at what's happening with the existing home market, what's happening with policy, what's happening in different markets, knowing that housing ultimately still is a local industry. So you'll see a little bit of that in today's presentation. We have 4 sections to get through. The first is just starting with the shifting market, acknowledging what's happening on the ground. We'll talk about inventory trends. What are we seeing today? What are we expecting to see in the future? We'll discuss how buyers are responding to today's market and how that really depends on who the buyer is. And finally, we'll finish with our final thoughts and provide some considerations to think about as we look over the next handful of years. So let's start with the market. And I think the first thing we need to acknowledge is that we are in a very dynamic place when it comes to mortgage rates. When I was doing presentations just 6 weeks ago, we were talking about the 30-year fixed rate mortgage basically getting to 7%. We know 7%, and when we got there, it was 6.8, 6.9 for a short period of time, and consumers responded the way you would imagine. You saw demand pull back pretty notably. But where we are today, we have interest rates that have come back down. So remember, it's a little bit counterintuitive when you hear that the Federal Reserve is raising short-term interest rates and yet mortgage rates are going down. That, again, ties into the relationship with the 10-year Treasury yield. We've seen the 10-year Treasury yield come down. We've seen mortgage rates come down as well. Now, I don't want to discount what changes we have seen with interest rates going up to 5% because that's clearly a shift from where we were just at the beginning of this year. And we are in the industry that is the ultimate interest rate sensitive industry. When the Federal Reserve is trying to change policy, we are one of the sectors that unfortunately feels the immediate impact of that policy change. But as we think about it, remember that we slow quicker than the rest of the economy. We also rebound quicker than the rest of the economy. And so I think at the end of the presentation, I'll talk about how there are a lot of things we should think about in terms of near-term planning and medium-term planning, and they will tell you two different things about the market. But as we've met over the past year, we've talked about how consumers can respond to higher rates by either really wanting to jump into the market, lock things before the market shifts, or consumers deciding to step back. And maybe they're doing so because they're a little uncomfortable, or maybe they're doing so because the math has changed enough. And as we look at the monthly mortgage payments, this is where we were at the end of last year. It was a market average, looking at home prices in each of those respective markets, and an interest rate of 3.1%. That was the average we had in December. When we look at where we are today, I've adjusted this down. I was presenting this at 6% interest rates a few weeks ago. Now we have the current rate at 5% to just capture that quick change, 30 to 50% change in that monthly payment. Now, again, this includes both home price appreciation and higher rates. So some of the markets that you're seeing in Florida are still some of the areas that have that higher level of overall home price appreciation. But when we look at the markets, many of you know that we like to look at hard data, but we like to supplement that with our division president surveys. This is talking to home builders across the country and getting some qualitative information from them about how the market is looking. And a question we often like to ask is, well, how does the market look relative to your expectations? And as you look at this, we have the results for May and we have the results for July. Probably no surprise to anyone that the majority of the responses said demand was slower than expected. You can see that shift to the right from May to July. July is also normally a slower time of the year. So to me, that makes total sense. But as you look at the responses, you can get the feel of it. We have about 30% of builders that said demand is slower than expected and not worrisome. In my mind, that's yeah, the market's different, but this is a very normal seasonal pattern that we haven't seen that much of over the past couple of years. We have 55% of builders, though, that are saying demand is slower and it's causing concern. And to me, that gives more questions than answers, because my question is, well, why is it causing concern? Is the market normalizing? Is the market softening? Is the market weak? I think there are a lot of things that we need to unpack to be able to answer that question. And as we look at putting the market into context, we like to look at sales, price, cancellations, and inventory. And I'll do that in today's presentation, but I want to give you our high-level take here, which is most markets across the country fall in one of these first two categories. They're normalizing conditions, even though it doesn't feel like it because it's slowed pretty quickly, but you can look at it in terms of context, and I'll show a lot of that in today's presentation. Some markets are just softer. They're softer than you would even see this time of year during a prior year, something more like 2019. Very, very, very few markets that have actually fallen into that weak conditions territory. So as we look at this and we try to say, okay, normal, soft, weak, what are some of the factors we look at? The first place we want to start is with sales. Now, remember, we in the new home market represent 10% of total sales. The existing home market represents 90%. And if you look at the annual rate of total existing home sales, we're back to 2019 levels. A very normal, very good year for housing. That's matched in our new home pending sales index. You're looking at the data here, I believe through June. Our July data comes out tomorrow. I will say very similar trend where the numbers are coming in right at 2019. But as we look at the market today, there are a lot of macro factors that will impact every market basically the same. When you're talking about rates going to 3 to 5%, it doesn't matter where you are, that's part of the backdrop. But we also know in local markets, there are so many other factors. How much have home prices gone up? How many people have moved there? What is the supply and demand imbalance? And it takes us back to looking at these stats on a more local level. Any of the markets that are to the left of the dotted line or below or on par with 2019 levels. Any of the markets to the right are performing better than they did in the same month for 2019. As you look at this, Phoenix, Sacramento, Salt Lake City, Vegas, Denver, Austin. These were the staple markets that grew the quickest, that had home price appreciation, that basically anyone you talk to said, this is unsustainable, it's happening now, but the market's really growing fast. I think long term, a lot of these markets have fundamentals that support growth with the positive immigration, with more companies moving there. But because they grew so fast, they also bumped up against that price ceiling quicker than what we've seen in other markets. On the right-hand side, you see some markets that are just difficult to get more homes built. Philadelphia, LA, so the homes that are on the market are still selling well. And then you also have a concentration in the Southeast. The idea that some of the factors I said that match the markets on the left, more people moving in, strong household formation, and an existence of investor purchases continues to drive some of the strength across the Southeast. So we can track what's happening with sales, and then we want to get a sense of what's happening with consumer confidence. I'll talk about confidence later in this presentation, but one way that you can quantify it is by tracking what's happening with cancellations. This is data from Redfin looking at how many existing homes that were under contract fell out of contract. And you can see that our level is above where we were pre-pandemic, but not as high as we were when the pandemic first hit. In some cases, people are just saying, if I'm going to buy a home and I've gone through inspection and the inspection's bringing up a lot of things and the seller's not willing to give me some money towards it, I'm not willing to purchase today. The sellers have become the buyers have become a little bit more discerning and selective compared to what we've seen over the past couple of years. Now, as we look at the new home side, we were able to call the inflection point in the market in April. And for us, that was because we basically came from an environment where there were no cancellations on the new home side, or if there was a cancellation, it was celebrated because we could resell the home for more money. But in April, we started to see a little bit more cancellations on the ground, and that share increased, hitting its peak, it seemed like, in many markets in July, so June and July. We saw that's where the overall cancellation rate had gotten to the highest point. Now, to me, when you look at cancellations, though, it's telling us a little bit about consumers, it's telling us a little bit about financing, but a really important follow-up question to me is, well, can these homes be resold? Right now, 13% of builders said easily, if we go through cancellation, we can easily resell it. 40% are saying for the most part. You have 50% that are saying no. But let me add a caveat. Our belief is that 50% of builders saying no, we can't easily resell it, but we can resell it if we use some incentives. And this is one of the benefits of the new home market over resale, which is the fact that 73% of builders have reported an increased use of incentives. There's money that's going towards closing costs. There's money that's going towards interest rates. And what a lot of builders are able to do is tell their sales staff, look at each person on an individual basis. What is their pain point? And what can we do to help address that? And as we've seen interest rates go from the high sixes to the low fives, we've seen some of those incentives shift as well. For a while, the rate buydowns were, hey, we can buy your rate down to 4.9%. Now we're seeing you can buy your rate down to 3.9%. And I've heard even lower than getting a 30-year fix in the threes. And that's important for consumers who we know were still interested in buying homes, but there was this record affordability shock. We're also seeing some interesting dynamics from a pricing point of view. Now, this is data from Redfin that looks at homes that are on the market that have posted a price cut. 7.7%, the highest level since 2015. As we look at this, to me, about 8% of the market going through a price cut is not that high. I know it is on a seasonal basis, but that number is still within reason. But as you look at this, it very much depends on the market. Some of the markets already talked about: Phoenix, Sacramento, Boise, Reno. These are some of the markets where you do have 40 to 50% of all of the listings that are going through a price cut. Doesn't necessarily mean prices have gone negative. It does mean that the days of, oh, I can list my home and I can list it for whatever and someone's going to buy it no matter what, seem to be behind us. From the new home side, we've been asking questions about base prices since the beginning of the pandemic. And what we captured in July was two record highs. Record high one is we had 71% of builders that actually kept prices flat. That's the highest we've seen since the pandemic hit. 20% of builders lowered base prices. And as we all know, lowering base prices is one of the last things you want to do for backlog reasons. But when we asked the builders why, sometimes it was because their competitor was trying to offload some homes, so they had to respond. Sometimes it was because there's a little bit more QMI, quick move-in inventory on the market. We'll talk about that. But again, as we look at this, follow-up question, well, if you lower base prices, did that result in an increase in demand? And for our research, we found that in most cases, as long as the price cut was not 1, 2, 3%, if there was a more notable price cut, it absolutely resulted in a spur in sales. We had one builder say they didn't sell any homes for 6 weeks. They cut prices. They sold 15 homes basically overnight. To me, this reinforces the idea of price elasticity in the market, of the idea that it was that record affordability shock. So let's take this discussion over, because pricing is really closely linked to inventory. And we want to get a sense of what's happening with inventory levels. Let's start national and then take it to a more local basis. As we look at overall active listings, remember, we saw inventory basically get scooped up real quick during the pandemic. Some people were choosing not to sell because there weren't other homes on the market, so they felt they didn't want to sell. Some people locked in their interest rate. Some people were just spending some money on remodeling and staying put. We have finally started to see some improvement in active listings, and this is what we want to see. More inventory means a more healthy, more sustainable market, means less levels of home price appreciation, means people sell their homes and then they got to move somewhere. And so it creates a little bit more housing churn as well. As we look at 2022 active listings, you can see where we are. We finally hit bottom. We are above our levels last year. We are still below our levels in 2020, and we're below where we were pre-pandemic. So listings are improving. The context obviously is very important that we continue to be extremely constrained. Depending on the market, I think this has been a really interesting number to track, because when you look at the year-over-year change, you've probably read headlines about listings up 50, 60, 150% compared to where they were last year. Now that's true, absolutely. You see that in the data. We came from record lows and we've seen inventory increase. When you look at 2019, a lot of markets still extremely constrained. You can see on this list, Raleigh, Sarasota, those markets down still about 50%. Phoenix, Austin, those are a couple of the markets that we saw that sales had slowed more notably. You are seeing in Phoenix, this is one of the few markets where actual active listings have actually gone above where they were in 2019. 2019, again, good, healthy year for the market, but you can see what a dramatic shift that was in the market in a short period of time. Then we like to look at quick move-ins. So you'll know quick move-ins as QMIs, standing inventory, speculative inventory. These are homes that can be moved into within 90 days. And what we saw when the pandemic hit is any builders that had quick move-ins were basically sitting on gold. Those were homes that people could lock in the rate, they could move in right away. We didn't have any concerns about, well, what's the timeline of how long it's going to get a home built. We had a sense of how much it cost to build those homes. So more builders did shift to QMI building over the past couple of years to have a little bit of control of costs and timelines. What we've seen, though, is that QMI number has increased pretty quickly. Back to the question, is it weak? Is it softening? Is it normalizing? We're back to 2019, 2020 levels of overall QMI. So to me, this captures more of a normalizing level. So again, because it happens so quickly, it just feels like a bit of a shock to the system. You can look at this by market. I know there's a lot of data here, but I just want you to see we have our current levels. These markets are sorted by the markets with the most QMI. If you track starts, you will see that these are also just the top ones: Houston, Dallas, Phoenix, Austin. Those are generally your markets that just have the most starts anyways. They have the ability to get more homes built, which is why we like to look at that year-over-year change. Again, that can be misleading. Look at Riverside, up 500%, but compared to 2019, up 12%. So trying to look at the 2019, I think that's a healthy comparison, especially when that's where we're seeing overall sales levels are today as well. But QMI becomes important because as we look at the inventory starting to get back to more normal levels, we have builders, 87% of them that we're talking to, that say they plan to slow starts in response to the change in the market. And in some cases, it's we can't start more homes with weak sales, or we're waiting for our inventory to sell before allowing for more starts. So the QMI is there, waiting for those to sell, and then maybe you could start more homes. And then you also see things like, well, we're planning to cut starts 50% for 2 months. And to me, this ties up very closely with consumers. The builder is saying, let me just pause, let me just reassess the market. And for a lot of consumers, it's yes, affordability, but very heavily consumer confidence related. Consumers are also saying, let me pause, let me reassess, let me see how the market continues to move. But as we look at this, starts as being the most immediate, you're starting on it, you're working on this over the next 6 to 12 months, but you also want to look a little bit further out. We can look at what are the plans for purchasing lots this year, what is the strategy with land acquisition. What we see is about 60% of the builders that we talk to are still planning to purchase the same amount of lots than they originally forecasted this year. You have a little under 30% of builders that are saying they are planning to slow their lot purchases this year for a few reasons. Again, some of our comments, the economics of deals written 6 months ago are no longer valid, or we've delayed some takedowns, but we're still buying this year. Then you look at land acquisition. I think this is one where when the pandemic first hit, we know that a lot of builders paused, wow, it's uncertain, passed on some land deals. And then when the market came back, there was a lot of regret of, the market slowed, but it came back so quick. I wish I didn't. Though at that point, we didn't know how the market was going to go. What we're seeing right now is, I think, a lot of that mentality, and I don't want to say scars, but some of the recent memory of maybe we don't want to pass on these deals is playing into today's market. We have about 60% of builders that are planning to cautiously move forward on their land acquisition strategy. We have a little under 10% that are saying full steam ahead. And then you can see we have about 20% saying pausing on deals and 15% saying bidding lower. And some of the comments are, land prices are higher than I've ever seen. Being diligent in getting the right deals that pencil, even if the market turns downward, is key, or being very selective. And this is where the market's unique. Is so as we're looking at some of the future plans, we also want to have a sense of what kind of lot availability is out there. And many of you know at Zonda, we track land and lot development. We can track total upcoming lots. And for the second quarter of this year, those numbers are up 28% compared to where they were last year. When you look at the pie chart distribution, this distribution almost always looks like this. It doesn't matter what quarter of data I'm showing you, but you can get a sense of total numbers. We have 6% of the lots that are under development right now that are coming to the market right now in the third quarter. We have 24% expected in the fourth quarter, and then we have about 70% in that excavation phase, meaning those lots likely come to the market in the first and second quarter of next year. Now, excavation is always going to be a larger share of the overall pot because we include some lots that likely won't come to the market in the first or second quarter. They kind of get bundled together, so that number is a little bit higher. Don't have FOMO that maybe you're not as active as some of your competitors because that it's a little bit of a ballooned number, but it can give you a sense of what's going to come soon, what's going to come in a couple quarters, what's going to come in over the next 24 months. And I think the big takeaway here is that there are many more lots that are expected to hit the market. So let's go to the discussion then on consumers. We know what's happening on supply here and now. It's improving. We know that there's a little bit of caution in the near term. We know that a lot of the land acquisition plans are continuing to move forward with some lots that are in place or under development. And I think the big question is, how does this market progress? And I'll show at the end of this presentation, we have a lot of data to support the enthusiasm for homeownership is still there, but we do have those speed bumps that we've felt very acutely this year related to affordability and confidence. I'm going to show you some numbers that you've probably seen before in one of my presentations, but it's the number that I like to look at to put things in perspective. The fact that if someone was able to purchase a $400,000 home at a 3% interest rate, the equivalent at that 5% interest rate is $315,000. This is the environment that we're finding ourselves in. We were in a place where people moved from $400,000 to $280,000 if they wanted to keep the payments the same, and that's where we saw the market really start to shift down. As we look at moving from $400,000 to $315,000, again, I don't want to discount it. That's a severe change in overall purchasing power. But we also know consumers are saying, okay, well, what am I willing to give up? And also, how is a builder willing and able to work with me? As we look at the buyers, when we're talking about the housing market, it's very easy to make blanket statements. I am tasked to do so on a regular basis, but we know it will depend on the market that we're talking about. We know that it will depend on the buyer group that we're talking about. And another question that we at Zonda have been asking since the beginning of the pandemic is, who are your most active shoppers? And for the past 2 years, we've had the same top 3 in this order. Number 1, move up. Number 2, entry level. Number 3, relocation. And that shifted in our most recent data. This is another new response that we had in July, where now we have number 1, move up. Number 2, relocation. Number 3, entry level. And I think that's because as you look at the move up buyers and you look at the relocation buyers, they still have the ability to tap what I often call the equities and the equity. They can still tap some of their home equity, in particular if they're going to move from a higher cost area to a lower cost area. The equity market, when we look at the S&P 500, we often like to use that as our proxy for the stock market. Again, about 6 weeks ago, we were talking year-to-date S&P 500 being down 30%. Last I looked yesterday, we were down 10%. So it's still down. It's still a little bit of a wealth impact. But for some of these buyers, they still have enough wealth they can bring to the table, either to do a sizable down payment or to do a cash purchase. And what I think is interesting about the cash buyers is so much of my presentation today has revolved around what we've seen in rates. And there's a certain part of the buyer group that does not care about rates because they're not financing the purchase anyway. And we're seeing that cash sales are holding up as a share of the overall market. Then you can look at investors. And there's a lot of ways to make sense of investors. You have the mom and pop investors. You have the institutional investors. You have ones that are buying to hold. You have ones that are buying to flip. We have them that are active in different categories. But what we see is overall investor activity higher than where it was before the pandemic. Starting to level off a little bit. We're seeing the mom and pop investors are less aggressive than some of the bigger institutional investors. But as we're looking at this, it's the first time price tier that is most attractive in general for overall investors. And that's playing into our first time buyers. That's playing into the fact that the share of first time buyers in the market has decreased notably. But this goes back to the earlier slide. Normalizing, softening, weak. We're at 35 now. We were at 34 when the pandemic, right before the pandemic hit. To me, what this is saying is capturing some of that normalizing trend of how this group is shifting down in response to what's happening with higher costs. But this group is also interesting when we think about our first-time buyers. This is a group that when I was doing presentations 5 years ago, 6 years ago, we were talking about millennials becoming first-time buyers. And then over that period, we've had a lot of millennials that became move-up buyers. So we're no longer just talking about this group of a certain cohort that is trying to get into the market. We have a more varied millennial population with us right now. But the group that I care about are the millennials that have not been able to purchase a home, that are losing some of their market share, that are finding affordability is the most difficult. And this matters because whether they buy a new home or an existing home, we want people to become homeowners for the wealth building effect. And for us in the new home market, if they don't start their entry home with us, that does increase our pool of potential move-up buyers in the future. And so we can look to the resale market for this. And again, we know resale 90%, we're at 10% of the total share. We know the price share, the price gap is normally a little bit wide because we in the new home market are a luxury good. It would make sense that things cost more. So what we wanted to ask the millennials is, are you willing to take a resale home that needs some renovations? And from our research, we found 80% that said yes. Some of them an enthusiastic yes. I would love to. How fun is that? Some of them saying, yeah, but I want to make sure I get a deal. And I bring this up because I think this is another avenue when we look at how that share has shifted in our market, still an avenue for first-time buyers in the new home, but more so I'd say in the existing home, and fueling some of the strengths that we're seeing in the remodeling space. So some of you may know we had Todd Tamilak. He is our remodeling and building product expert here at Zonda. And when I talk to him about remodeling, he shows this stat, which to me is really amazing. It's looking at the number of single-family homes that are in the prime remodel years, those between 20 and 40 years old. And what he likes to point to is look back to the mid-2000s and look at the share in that prime remodeling and look at the forecasted direction. He calls where we are right now the golden years for remodeling, where we expect to see some increased activity there with, similar to the for sale side, a little bit of bumpiness in the near term, but a lot of that strength partly fueled by what we've seen in equity driving the market forward. Then we think back to those first-time buyers and we say, okay, maybe some money towards the resale market, maybe a little bit of a focus on remodeling. What about the rental market? Now, what we've seen, we have an expert named Kimberly Byram. She says this rental market is still extremely strong, still very little availability, record high numbers across a lot of different metrics, from the renewal rate, so people that are already in an existing existing rental unit choosing to stay put. We're seeing record levels of rent growth that many of us are very familiar with. The fact that in a normal year, rent growth should be 3% per year. And what we're seeing in some markets is 1 to 3% per month. The rising rents, as they look today, have tilted the numbers towards rentals. So she's seeing some of that demand in that multifamily space where builders are offering incentives, concessions, which would be the equivalent on the rental side, not really increasing, but the risk, of course, being job losses. So what Kimberly believes is this market does outperform in terms of starts, in terms of demand, the for sale market, when the for sale market goes through an affordability shock. But if we see widespread job losses, that's the only time where that starts to shift and you actually see rentals follow some of the same paths we've seen in for sale. But as we look at this, you can see that it's a mixed message where there's so much unrelenting demand. And again, we'll provide some stats why we believe that to be the case, but also an adjustment period. Part of that related to right now, the highest share of responses we have is that buyers are either having qualification issues, again, related to rates, or what we're seeing with hesitancy from buyers. You can see that's the number one issue where we have 94% of builders saying this is a true problem that they're feeling on the ground. And I think you don't blame consumers when you look at the headlines. Let's step back to 2018. 2018 was the last time we had this mortgage rate shock. And as we were tracking the market, sales were still holding up for a while after interest rates had gone up. But then we started to see headlines shift and start to be pretty unfavorable compared to where they were. This is again back in 2018. And that's when we saw that combination of higher rates and headlines start to impact consumers more notably than just higher rates. And we're seeing that today. When you look at some of the headlines, there's things like it looks a lot like a housing bubble. Keep an eye on these overvalued housing markets as the housing boom implodes. The Economist, who called 2008 housing bubble, warns of home price decline. All you see here is last cycle, bubble, scary, scary, scary. And so it makes sense that hesitancy from buyers is our number one concern. But I also think it's incumbent on us to understand and be able to explain how this market is very different than last cycle. And some of those parallels create a lot of fear, but I don't think they're backed by that much in reality. As we look at builder balance sheets, we know that they're exceptional. In some cases, the best they've ever been. Last cycle, that wasn't the case. When you look at consumers, those that have been buying, they have skin in the game. There's down payments. They had great credit scores. Debt to income ratios have been reasonable. And as we look at these numbers, remember 26% of loans originated last cycle had a credit score under 660. Today, it's 6%. Last cycle, 24% of borrowers had a credit score of 760 plus. Today, it's 70%. Now, these numbers have rolled over a little bit as affordability has gone up. You've seen some of the overall credit deteriorate a bit, but deteriorate again goes back to, well, does that deteriorate like 2008? No. Is that deteriorate like what we saw in 2019, early 2020? Yes. Goes back to the discussion of how the market has shifted. Doesn't mean there won't be adjustments to the market. We already talked about sales going from 2021 levels to 2019 already feels like an adjustment. But we also have to keep thinking forward with the market. The idea that we do know there's this unrelenting demand for the market, but not just builders, developers, consultants, suppliers, all of us. The industry has shifted from taking orders to actually selling. And I've had a lot of conversations of just how do we work with our sales team and our marketing team to go back to the basics, to do what we had to do in 2019, but we haven't had to do over the past couple of years. And I think an important question is to think a few steps ahead. Think about one of the first things that I started this presentation with. We're the ultimate interest rate sensitive industry. We slow fast, we rebound fast as well, typically. Obviously, last cycle kind of breaks that mold. But as we look at this, think through, if we do fall into recession, what's next? How do you plan for that? We're not in an industry where we're like Target that has to just plan for the next season. We're planning for multiple seasons. We're looking at land development, community development that takes multiple years. And as we look at the millennials, this is a group that obviously I've spent a lot of time studying. I'm not saying that the first time buyer pool is as high as it was, because demographics told us 2020 should be an awesome year because of demographics, and we had some of those people already convert to be homeowners. But it goes back to, we have a more varied buyer base today, and from our data, what we see is a record level of people that plan to purchase a home. And maybe they're sitting on the sidelines right now. Maybe they're waiting for affordability to get better. Maybe they're waiting for inventory to increase. But from our data at Zonda, from our annual millennial survey, we had the highest number of millennials that do not already own that plan to own over the next 1 to 3 years. To me, this brings up the importance of planning and understanding the midterm, the near term, which is uncertain and bumpy and significantly slower, and we feel that, but also thinking through, what does that next step look like? What does that medium term ultimately look like for housing demand? So with that, I will stop and I will turn it back to the BFS team to see if we have time for questions. Thank you.
Sure. Thank you so much, Allie, for the insight. And the Q&A panel has been lighting up as you've been going. So let me give you a second to catch your breath there and get a glass of water. You'll see I just messaged you some questions that have come in from our audience here. So if you want to peruse those and maybe read aloud any that you feel would be appropriate for the broader audience, and then we can start responding to them. One question I have received several times here is, will we get a copy of the presentation following? Yes, in the next 20 to 48 hours, a copy of the presentation will be coming out along with a recording, so everyone can have that for their reference moving forward. So with that, I'm going to turn things back over to you, Allie, to read aloud any questions that I've sent you. And then if we have any time, we will try to get to the other questions that are coming in real time here.
Awesome. Thanks, Jack. And I'll go through a couple of the questions and then I'll turn it over to you to see if there are any more questions for the BFS team. But I think one of the questions that's pretty interesting and relevant in today's time is, do you think homes for rent category will grow? And if so, by how much? And are you hearing anything about national builders entering the built for rent market? So that's 3 questions, and I think you could spend a lot of time answering each of them directly. But we'll start with the first one, which is, do you think homes for rent category will grow? Yes. I'll start with the institutionally managed. When we look at our forecast for multifamily starts, this is really one of the bright spots in terms of overall activity. I bring back in Kimberly Byram, our multifamily expert, and she said there are so many multifamily communities that are in the pipeline, that development is underway, and she thinks those will come to the market over the next couple of years. When you look at the built to rent space, we're already seeing this space grow pretty notably. And I'll take this to the second question, which is by how much. As we look at the data, it will depend absolutely by market. So let me give you an example. In somewhere like Phoenix, there's the same amount of built to rent communities in the pipeline than there are built to rent communities that are already on the ground. So in some markets where the math pencils, where land is relatively more affordable and relatively easier, better accessible, we're seeing that's resulting in an increase in single family built to rent. We're seeing the same thing in Dallas, Houston, Jacksonville, Atlanta, San Antonio. Those are some of the markets where we've seen the most growth in the built to rent. And then let me go to the third part of this, which is, are you hearing anything about national builders entering the built to rent market? Yes, either becoming developers themselves or building homes and selling them off to some of the big organizations. So Jack, I know I talked a lot. I'll pass to you if there's any BFS questions, and then I'll come back for more if you want.
Sure. One question that we have that is for the supply chain group here is, what is your 2x4 random lengths SPF forecast for 2023? Will we see? Basically, that's what the question is here. Apologies. There's an acronym I'm not familiar with, so I'll just leave that in the ether for you to respond to.
Jack, I'll take it. This is Jeff. So the question's around, will we see $2,000 board foot lumber again? And I think with the housing start demand that we're seeing and the production that we're hearing from the mills, I think we're probably leaning a little more towards that the dollars per board foot will hover around the area that it's currently at right now through the end of the year. We'll see some seasonality spikes, but we probably see it to stay in the same range it's at right now.
Excellent. Thank you very much. Hallie, I'm going to turn things back over to you to continue reading questions. There is a ton of questions coming in. Some of them are specific to geographies and markets. We will do our best to address those offline, and I'll make sure that Allie gets connected with those following the presentation. Turning back over to you, Allie.
Awesome. Thanks, Jack. So there are two different questions that are asking pretty much the same thing. So let me read them and then I'll address them both. So do you expect the mix of multifamily to single family homes to trend towards multifamily due to affordability long term? Is there any change to consumer preferences? And then similarly, does Zonda see an introduction of new products to the first time buyer due to affordability, for instance, smaller square footage? So the answer to all of those, yes, 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 and yes. What we're seeing is there's a lot to unpack, but we asked builders in one of our surveys about what kind of products they anticipate coming to the market to help address for affordability. And there were some builders that said, you know what, it's just not going to work. Our market is just too expensive. Land prices are too high. Labor's too high. We can't. For the most part, though, there were builders that were saying, we're looking at more single family, higher density detached. So trying to stick with the detached. If you want to see a great example of this, look at We Cottages by Boulder Creek Neighborhoods. They have very interesting product that even that price has gone up like crazy. You'll see it. It's a very small product, but it serves a need in the market that consumers were really happy about. We're seeing more accessory dwelling units in the markets that it makes sense. We're seeing more condos in markets where we don't have the big construction defect litigation laws, more townhomes. We're seeing the shift down in square footage. From our survey responses, we have builders saying that they're planning to keep their square footage about the same. From our actual hard data in Zonda, we are seeing a bit of a shift down in overall product size. And I think these questions, I don't think consumers have all of a sudden said, you know what, for years I've wanted a single family home. Now I really want an attached home. I don't think it's actually a sentiment shift. I think what we're really seeing is more of a acceptance and willingness that if I need to buy homes and land, it's not easy to find more homes that are coming to the market. I'm willing to accept that. And the final thing that I'll say to this is when we're looking at some of the markets that grew the most, and there are also some of the markets that I said slowed the most, they're the markets that have the highest share of their product that is single family detached right now. And I bring that up because I live in California now. I'm originally from Cleveland. In California, we've had to do really intense density solutions, changing products, thinking about different products for years. Somewhere like Cleveland, yeah, they've thought about affordable products, they've shifted product, but it hasn't been as severe as what you've seen in some of these other markets. And I think there's still a lot of product changes, working with architects that have worked in these high cost areas that could help address that. Jack, do you want me to keep going or anything else for BFS for now?
Nope, you can keep going there, Allie.
Okay, cool. Another question. Okay, so another question is, what do you expect new home prices to do over the next few years? And I have a new phrase that I say to answer this, which is, there are two ways to get in a fight in the home building industry. And I think one way is to ask someone for their home price forecast, and another way is to ask someone how undersupplied they think the market is. Those are the two most hot buttons, most contentious issues. I will tell you our take on home prices. You may disagree with me, and that's okay. I think we're all just trying to make sense of the market. But as we're looking at our forecast, we are not under the belief that home prices always go up indefinitely. There is time after time after time where we have had a slowing market and prices do correct, albeit they correct modestly and they correct for a very short period of time. And so I think that becomes important, is that we believe in a modest home price correction. We don't believe it looks anything close to what we saw during the Great Financial Crisis. We know that the underlying statistics are very, very different. From history, it says between 6 and 12 months, home prices go back to positive growth territory. And I think what makes this market unique is the existence of, and maybe I'll use this a little bit wrong, but the existence of dry powder, or the existence of money sitting on the sidelines of people or investors that are saying, when we see the market correct a little bit, we're ready to jump back in. So I think that our belief is a price correction, but not too long and not too deep. Let's see, anything else? Okay. Let me take the first part of this question, and I'm going to pass it to the BFS team to answer the second, because I know from talking to you guys, even as builders change their strategy, it doesn't mean that there's been as much of a shift on the remodeling side and the multifamily side, so you may have something to add. So the question is, and I think this will be our last question, Jack, unless you say otherwise, as the builders seem to be slowing their production of new homes, will this affect the price of materials, and if so, how long will that take? So I'm going to just reiterate from my perspective that we have seen that starts activity slow. We saw that with the data that came out yesterday, but I know the BFS team, you're in, you have the constant information about what this means for pricing. So let me pass to you to see if you have anything to answer that question.
Yeah, thanks, Allie. This is Jeff. In certain areas like commodities where there was the production was exceeding the demand, we have seen pricing come down over the last few months significantly. But in other areas like building products and some millwork, where the products are still on allocation and the demand is exceeding production, we're not seeing any price relief at the moment. We probably see the price being stable through the end of the year, just because of labor costs, fuel costs, and other things that are still hitting manufacturers on a monthly basis.
Awesome. Thanks, Jeff. And I think at this point we're at time. So Mike, I'll bring you back in to close things out.
All right, Allie, thank you very much, and great job as usual. We really appreciate you joining us on these calls and providing your very useful information and insights. So as we wrap up, I just wanted to say thank you to everybody on the call for your time. If there are other subjects that you might like to hear about or topics on our future calls, please feel free to reach out to communications@dldr.com, which is also the email that sent you the registration information. We'd love to hear from you and any topics you'd like us to cover moving forward. But again, thank you for your partnership, and I hope everybody has a great day. Thank you.